Okay, example for problem number 3. We have Bob Company. It's currently manufacturing its own component parts. There's an outside supplier. They've offered to sell a component to Bob for 30 per unit. To evaluate the offer, Bob has gathered the following information relating to its own cost of producing components internally. And you're given a list of costs. So we have to look first at the cost to purchase and then what our actual costs are to make it ourselves. So they tell us the cost to purchase is 30. The cost to make it, we're going to include our direct material, direct labor, and variable overhead. So direct materials are 5, direct labor should be DL. Direct labor is 9, variable overhead's 3. Fixed manufacturing overhead that we can trace. They tell us within the problem, they show it as $16, but they tell us 30% is supervisory, 70% is depreciation, which has no resale value. So that 70% is irrelevant. What we're going to do when we determine our traceable cost, we're going to take that $16, multiply it by 30%, or by 30%, and that gives us the 480. The common costs are totally irrelevant to this decision. Whether or not we make or buy, we still have those costs, so we're not going to include those. So if you add up our cost to make it, they total $21.80 per unit. Cost to buy it per unit is 30, so there's a difference of $8.20 per unit in favor to make it. The total, and in the book I know they total it as they go along. I just do it at the end. I think it's faster. So you would just multiply cost to make, 2180 times 10,000 units, which is 218,000. Cost to buy, 30 per unit times 10,000, which is 300,000. So if you look at the difference between the two, 82,000 better off if we make it. At the bottom, they give us additional information. They can use the free capacity to launch a new product. The segment margin of the product would be 50,000 per year. Now we want to look at what does it cost to make and buy. Well, we already know our total cost to make is 218. We already determined that. We have an opportunity cost, and I'm sorry, I think I said 50,000. It was 90,000. Excuse me. We have an opportunity cost here of 90,000 because the segment margin would be 90,000 if we went ahead and made it. So that means we lose this money. So the actual total cost to make it is the 218,000 plus the 90,000 we lose in margin. So our total cost to make it is 308,000. Cost to buy doesn't change, it's 300,000. So if we compare the two, we are now $8,000 total better off if we go ahead and buy the product. So when you do have a situation where you can perhaps manufacture new products, you will often run into changing your decision.